This is a monetary game, and you can keep these little monetary bubbles going for just so long. The history books are pretty clear. It's very difficult to increase your enthusiasm from a state of mild hysteria where we are today.
The financial markets all over the world have seen a slowdown since the beginning of the 2020s, first owing to the pandemic, then to the Russia-Ukraine crisis, and even the growing tensions in the Middle East. But what if someone wants to say that we were not at our worst point yet? What if someone said that things could be even worse? Well, that is exactly what Jeremy Grantham is saying. But who is Jeremy Grantham? Roberto Jeremy Goltho Grantham is a British investor and the co-founder and chief investment strategist of GMO LLC, an American investment organisation. Having a keen eye on the financial markets, Grantham has been accurately able to predict market fluctuations for more than 5 decades now, and for most parts of it, he has been right. He correctly anticipated the bursting of the Japanese bubble in the late 1980s and the dot-com bubble in the late 1990s. He also warned the world about the housing bubble in 2008 and predicted the financial crisis that would follow. And then we all know what happened in 2008. Now, coming to what Grantham has to say about the future. At present, with rising bullish enthusiasm, Grantham predicts that there will be an interest rate cut in the coming months. An interest rate cut is expected to drive the market up. But before we rejoice, it is better to take a look at the historical data at hand. It is important to take a look at the 4 major US bubbles that have occurred in the last century to understand the consequences of the upward climb better. In 3 out of the 4 bubbles, in 1929, 2000 and 2007, what followed the interest rate cut was that it led to the majority of the market rate cuts. This just reiterates the impact that a single interest rate cut can have when negative fundamentals are in the picture as well. But the opposite has also happened as well. In 1974, after a significant 62% real decline in over 2 years, the market actually rose up, which coincided with the first rate cut by the Federal Reserve. But a single incident should not overshadow the mixed results that the interest rate cuts by the Fed have had over the last century, especially the 2000 and 2008 first rate cuts. The 2000 and 2008 cuts showed the world that the first rate cuts alone do not lead to the ending of a bear market. The reason this point has to be reiterated is that investors have an inherent tendency to ignore these downfalls in the past and move ahead with a positive attitude and unknowingly jump it into the pit themselves. Now, Jeremy Grantham has started warning about the arrival of Phase 2 of the ongoing stock market crash. While doing so, Grantham also highlights the various assets that the investors could purchase, which offer attractive value propositions. In Grantham's own words that he wrote in an article by GMO, the first and easiest leg of bursting the bubble we called for a year ago is complete. The most speculative growth stocks that led the market on the way up have been crushed, and a large chunk of the total losses across markets that we expected to see a year ago have already occurred. But that is not where things end. The situation actually gets more complicated from here on out. At present, the valuations, although they are reduced, are nowhere close to the long-term averages. Based on historical data, they have a tendency to overcorrect themselves below the trend line as the fundamentals deteriorate. Now, this is an outcome that is highly likely, but the timing and extent of the next market decline are fairly uncertain given the ever-changing landscape of the world. Adding to this, there are multiple factors that affect the pause or delay of the bear market, like the changing presidential cycle, the ongoing strength of the labour market, the reopening of the Chinese economy, and the subsiding inflation. The level of deteriorating corporate fundamentals will determine the next 12 to 18 months, said Jeremy Grantham. Grantham also warned that long-term investors should be wary of the changing interest rates and the potential for a downturn in the global property market, all weighing in significantly on the economy at present and in the near future. Grantham shifts our attention to the Russia-Ukraine war, the consequences to the global market, and the uncertainty surrounding it. He points out how it would impact the market for grain, oilseed, and fertilizers. Russia invading Ukraine created high instability on a geopolitical level, and the final consequences of the invasion have not been assessed so far. But the preliminary consequences include limiting Europe's energy supply and possibly affecting the vulnerable developing nations surrounding the countries. From an economic and financial perspective, investors are not keen on uncertainties. Most likely than not, uncertainties yield negative outcomes and have led to the usage of the term polycrisis. Polycrisis refers to the occurrence of multiple catastrophic events simultaneously. Grantham suggests that even if a single event were to spiral out of control, it could lead to severe global recessions. That would make the 2008 recession seem like child's play. According to Grantham, the most important factor to keep an eye out would be for the bursting of the housing bubble, which is more likely to have a more severe impact as compared to the decline in equities. And that would just be the beginning. While in the US, there has been an extreme overpricing of the stocks, in other parts of the world like Vancouver, London, Paris, Shanghai, Sydney and Taiwan, the real estate markets have shown cases of overpricing as well. Corrections in the real asset or the real estate market would much take longer corrections in the equities market. And the real estate market or the housing market is directly linked to other sectors of the economy, like construction or other related industries, making it one of the most crucial indicators of an economic slowdown. And who would be affected the most? Grantham suggests that most affected sect of society would be the middle class, who tend to rely on real estate and housing as part of their retirement plans. Their vulnerability to declining housing prices would eventually lead to consumer unease. In fact, Canada and Australia, which had pretty stable real estate markets, have already started seeing a decline in prices. According to Reuters, Canada has already seen a 12% drop in the last year, and it is estimated that the other markets considered to be overpriced are soon to follow. Coming to the S&P 500, Grantham forecasts a 16.7% drop by the end of the year, reaching a level of 3,200. This is without accounting for inflation. If that is taken into consideration, then the real decline would reach 20% for the year, and the number would be double that if we take into the period of the last 2 years. Grantham also suggests that there is a possibility that the decline will hit the 45 or 50% mark as well. A modest overrun past 3,200 would take the entire decline to, say, 45 to 50%, he wrote in GMO. Apart from this, Grantham also takes into consideration the presidential cycle, which is a fairly recurring event that has significantly impacted the market as well. He suggests that the change in the cycle would actually prolong the bear market. According to historical data, in the months between October of the second year and April of the third year of a presidential cycle, the returns have been equal to remaining months of the cycle. Now, the probability of this occurring on its own is quite small, but the fact remains that it has repeated itself over the last 45 years. The US is currently in a favourable period. This means that post-April 2024, there could be an impending bear market that's been prolonged for a while. Grantham also brings into the picture the relationship between recessions and market troughs. It is seen that the great psychological bubbles, as seen in 1929, 1972, 2000 and 2006, showcase different dynamics as compared to the usual system of the bull market. In the cases mentioned by Grantham, the lowest points of the market took a significant amount of time to even materialise. In general cases, recessions precede a bear market by almost 7 to 8 months, but in the case of a psychological bubble, the bear markets actually follow much later. Keeping this in mind, Grantham suggests that the final low for the current crisis should hit well into 2024 or maybe even 2025. But not every news is negative. Grantham also brings forth investment opportunities that would still be a reasonable bet. GMO's 7-year asset class forecast revealed that emerging markets are actually reasonably priced. He also suggested a strategy known as the equity dislocation strategy, according to which it is better to take a long position in monetarily priced stocks while it is better to take a short position in overpriced ones. The strategy provided a positive double-digit return last year. But in conclusion, while it is true that the US equity market does face challenges, and there is a very high possibility that we are not close to a weakest point, there are investment opportunities that are still available. And when someone with Jeremy Grantham's caliber is the one saying it, it is much better for our own good that we listen to it. For more similar updates, subscribe to our channel and ring the bell icon.